Okay, guys, welcome to the show. Thanks for joining me. This is the ARMR Report. I'm your host, Brett Rosenthal. ARMR stands for Algorithmic Risk Management Research. And, there has never been a time in our equity markets where risk management was so important. Let's just start the show off right there. Let's talk about that. This is a live trading desk. We combine traditional fundamental analysis with millennial tools of execution, primarily algorithms that we have built. So they're proprietary algorithms based on probabilities and statistics, trying to put us on the right side of probabilities and statistics, and putting capital at risk when the reward is big enough for the return we think, for the risk we're taking. So what I'm trying to impart to you on this show every day at 12 o'clock is the value of using algorithms or, basically a computer system to help you execute in a market where volatility is back in a big way. And it's not going anywhere. It's just going to get more volatile. And I'll get to the reasons for that in a minute. 80% or more of all trades during the day are executed by algorithms. So if you're not executing with algorithms, you're being taken advantage of. That's it. I can't say it more plainly than that. And so on this desk and on our website and on this show, I try to share with you the value of 30 years of experience doing this. The last 6 years, we put a lot of capital, both our own personal time and financial capital into building these algorithms to help us add and reduce risk when appropriate. We start on our trading desk with the idea that we have to protect capital first and capture upside second. And that, I think, is going to be more true in the next decade than it was in the previous decade. The last 10 years after the financial crisis, you had an accommodative Fed, accommodative central banks around the world, the massive printing of paper currencies to buy financial assets. So you could get away with avoiding the need to protect capital because you were always supported by the Fed. At the moment, the Fed's not supporting you. So if you're curious why your equity portfolio has suffered in 2018, there's one simple reason. It's not Donald Trump. It's not what's going on politically. It's got nothing to do with earnings or momentum or the economy. It has everything to do with the fact that the Fed's been raising rates and continues to say that they're going to raise rates. And when they say they're raising rates, what that's really doing to the economy is sucking liquidity out of the economy, sucking liquidity out of the equity markets. And so you get markets like this. All of 2018 is a massive top. Maybe I'll do a screen capture for you like I did the other day on the S&P. You can find that on my YouTube channel. It's Rosenthal Capital on the YouTube channel. And I did a screen capture last week to show you why we're shorting the market now. And I'll get to that in a minute. But let me just say, I might do another screen capture just to show you the top that the market has formed throughout 2018. And now that top is breaking down. So let's go to our algorithms. That's why we start there every day on this show. We've got proprietary algorithms to trade the volatility, to invest correctly probability-wise for the top indexes that we follow, the S&P, the NASDAQ 100, the Dow, small cap index, and we like to favor the momentum index, MTUM. We use exchange-traded funds, another millennial tool, to invest. So it's not hard. We're not doing things like equity index futures and such like that. It's very simple. So that's our first layer of defense. If that layer is not right, we don't start buying groups. We don't start buying individual stocks. If we're not risk on across the board on those big indexes, we don't see, not only is there no point in buying individual groups and stocks, but it's very dangerous. It's very dangerous to think that your fundamental analysis will carry you through a stock bear market or a bear market in general. It won't. It won't. I don't care how good the idea is. I don't care how great the theme is. When the markets break down, and particularly in the modern age, when the markets break down, everything suffers in a very big way. And that's why I titled the show, Is It Time to Buy Gold and Gold Stocks? I don't know the answer to that. We're going to explore that a little bit later on the show. And I tweeted out, please follow me on hashtag ARMR Report if you want to get more up-to-date understanding of how we're positioning ourselves on the trading desk. It's hashtag ARMR Report, R-E-P-O-R-T. And we talked about the cannabis stocks, and I'm going to share with you some of my thoughts there. You know, I'm a big fan of that space. I think it's a great investing opportunity in the next 1 to 3 to 5 to 10 years. That doesn't necessarily mean it's a great investment opportunity in the month of December. Okay. So getting back to our big indexes, these 5 indexes are telling us to be in cash. They've been telling us to be in cash for a while now. And again, this is a live trading desk. So when you see me looking off to the right here, I'm actually looking at a computer screen that's telling me we got long on an intraday trade, the NASDAQ 100 at around 1130, ran up to the VWAP. We booked some profits there. It's coming back down, and I'm just taking a peek to see if there's anything I want to execute as it comes back to our entry price. Not really. Okay. So the takeaway right now is that we're in a bear market across the board. And we started telling you that the problems were raising their ugly head on the 24th of September. Just go to our website, rosenthalcapital.com, scroll to the bottom. You'll see all of our podcasts. Go back to that date. You can listen to that podcast. We said the small cap index is breaking down. By the way, that was right near the high of the year. We said we're raising cash in small cap and mid cap. And we said on that call that when small and mid caps break down, they're like the canary in the coal mine. They go down first because they have the least amount of institutional support. Please don't get confused. When you make money in the stock market, don't get confused that you've made brilliant ideas. You've had brilliant ideas and you've made these great investments fundamentally. That's not really why you get paid in the stock market. You get paid because institutions put a lot of money in that stock or that group. Your institutional flow of funds comes into that group. And you were smart enough to get in ahead of that wave of investing. But you could have the same exact fundamentals on a stock and think it's the greatest thing in the world and lose money on it. And you don't understand why. The reason is institutions don't agree with you and they're taking money either out of the market in general or out of the space. So it behooves you to understand what institutions are doing with money. Individual investors do not sustainably push stocks up. This is a fact. If you want a multi-month, multi-year move in a group, you need institutional flows of money. Endowment funds, pension plans. Okay? The big guys. And if you get that, then you can get sustainable moves. So right away, when we have a breakdown in small caps, the reason we focus there is because institutions have the smallest allocation to small cap stocks. That's the first place where liquidity dries up. And it's the least important space for major institutions. They're running big dollars. They can't force them into small cap stocks. They go into the big names. Then they go into mid caps and they go into small caps in a little way. So when things start to go awry, the small caps get hit first because there's not enough support from institutions. And of course, mid caps right behind it. And so when we saw that on the 24th of September, we said, start protecting capital. Book some profits, raise some cash. Make sure you're defensive in here. Don't overstep. Don't be adding to positions in here. There's many different ways to take the information I'm sharing with you on the trading desk using our algorithms and use it in your own portfolio. At the very least, when we're saying to you, hey, it's a risk off small and mid caps, at the very least, you could stop buying stocks. Just stop. Don't chase every rally. That's one way to start using algorithms. And when we say risk on across the board, then you can start putting capital back to work. Hopefully you've built up a little cash at the same time. Okay, so we're risk off across the board. More importantly, I've been saying the last week or so, I've done something I haven't done in a very long time, and I've gotten short the market. And that's paying off in a big way. I hope maybe you guys have joined me on this. It's hard to get short. And it's not for everybody. So when I say you guys have joined me, only the most aggressive of accounts should be shorting ever. There's nothing wrong with holding cash when the market implodes. You're a winner every single day as the market goes lower and you're in cash. For two reasons. One, you've protected your assets. And two, your mind is clear so you could take advantage of the weakness. That's very important. When you're shorting, your mind's not clear. You're making money. You're feeling like a hero. Everyone's getting killed and you're making money, so you feel like a hero. But that clouds your judgment and it makes it harder to get long when the turn comes. So be aware of that if you are a short seller. What we like to do is use equity puts on the big index ETFs, the S&P, the Dow, the small cap index, the mid cap index. We use puts. I usually don't go out more than a month. I usually take it close to the strike. I'm just trying to set up a position where I can book some profits. Hang on a second. Hey, brother, can I talk to you in a little bit? Okay. Okay. So what we're looking to do now, if you're trying to set up shorts, I mean, our shorts are already on. When we got stopped out across the board on all the indexes last week, we told you we're not only out, but now we're in now we're short. And the reason we're short is the market tried 3 attempts to get above the 50 and the 200-day moving average. It failed miserably, and the small cap index continues to lead on the downside, making new lows before the rest of the indexes. So to us, when you're below the 50 and you're below the 200-day moving averages, and both of those averages are in downtrends, that's when, statistically speaking, the meat, the meat of the trade is there for short sellers. It's not when the market's making a top. Not that you can't make money during that period, but that's more of a trader's market. The real meat of a multi-week trade on the downside comes once the market gives up the ghost of the bull, and that downtrending 50 and 200-day keep pushing the market lower and lower and lower. So what we look to do is short at the top of that downtrend and then cover some or all at the bottom of the trend, preferably on big down mornings. Didn't have big down morning this morning. It was a flat kind of open, actually a little bit up on the open, and then it sold off, made some new lows. Now the market's trying to recover, but so we're still short there. We're looking for, I mean, I might cover some of those puts if we had like a big gap down open. Say, okay, we're close to it. Hang up on that guy. You already missed the trade, my friend. If you want to be a part of that, you had to talk to me last week. All right, let's get back to today's show. All right, so We're in short the rally modes. We haven't gotten the opportunity yet. If you're following me on Twitter, I keep talking about the RCM VWAP. That's very important. When we're looking for a rallies back to previous volume weighted average prices. I call it RCM VWAP because we have our own proprietary VWAP that incorporates volatility and changes depending on the asset we're looking at. So when we're really far away, in this case, on all the averages, we're far away from Monday's VWAP. And that VWAP is just typically a magnet to draw prices back up even in a downtrend and draw prices down in an uptrend. So it tends to be a great place to look for entries. So when you get too far away from a major VWAP, which is really just the previous day or today. So when I'm talking about VWAP retracements, I'm talking about previous day VWAP or top day VWAP. So we're right at the top day VWAP. So when we sold off hard, we were 3 standard deviations below that VWAP at 11 o'clock, 11:30 when the European markets closed. We had that relief rally back up to the VWAP. That makes sense. And now the question is, will this rally be strong enough to take us back to Monday's VWAP and close that VWAP gap? And if it does, then we start looking to put some shorts on again, depending on how it trades up there. All right, so that's how we're looking to short the rallies. Let's move on. 30 years in the business. I've been doing this a long time in many different strange market environments. The 30 years that I've been doing this professionally have been a really, the Chinese have a saying that, may you live in interesting times. That's what they wish for you. May you live in interesting times. Lord knows the last 30 years have been an interesting time for investors. We had an explosion higher because of the internet investment wave. We had collapses in 2000 and 2001. We had a financial crisis in 2008. Then we had an engineered bull market by central banks for the last, 9 years. And now we're going into the next phase. And this next phase looks to be dangerous and ugly. And what I can tell you from all those experiences, when it comes to bear markets, there is nowhere to hide except for cash. But when it comes to your investment themes that you love, one after another, they get knocked off. That's just the way it is. Now, you want to be a long-term holder, you're saying to me right now? You want to say to me, hey, it's okay, Brett, don't worry about me. I'm holding this long-term. I'll make it through this correction. I wish you the best of luck, my friend. I hope you can do it. Okay? I have confidence in you. Good luck. But I would do nothing for you if I was just a cheerleader. Okay? And what I can tell you from my experience doing this for 30 years and working with individual investors like yourself is that 90% of long-term holders of buy and hope investors get blown out near the bottom of bear markets. They cannot stand the heat. And let me tell you something. The closer you are to retirement, the more that happens. Okay, if you're in your 30s and you're socking away money and you're not going to look at it, fine. But if you're looking at retirement in 10 years and here's your nest egg and it drops 30% in 9 months, you end up saying, uncle. And then the market reverses and rockets higher and you're sitting there saying, what the heck just happened to me? Algorithmic risk management research can help you avoid that destructive behavior. We raise cash when the risks are too high for the reward and when the probabilities and statistics are against us. So even if you're a long-term hoper, at least take some of your portfolio and protect it during times like this. There is nowhere to hide. That gets me to my next point I want to share with you. I love the cannabis stocks. You know it. I've been talking about it ad nauseum going back to the middle of August, and we've made some good money in the space. Okay. If you've been following me on Twitter, you know where we're in, where we're out, where we book profits. Then we take a step back in. You know, our favorite position was Kronos, right? Fundamental analysis is not dead. Kronos, I've been saying to you, the Constellation Brands is not the only guy going to put a lot of money in this space. They put $4 billion into Canopy. I said, we got to do homework to find the next guy that's going to be the investment magnet. And I came to you and I said, I think it's Kronos. I've listened to a lot of conference calls, and Kronos is setting up their business just like Canopy. They're focusing on intellectual property so they can have high average selling prices or ASPs, high margin businesses, and it's attractive. And lo and behold, Altria comes out last week and puts $1.8 billion in the company. Great. Fundamental analysis worked. But if you're following my Twitter feed, last week, hashtag ARMR Report, I told you I was selling the cannabis stocks on that news. I booked that profit in Kronos. I am not long MJ. It's a simple reason. I'm short the market. This is the time in the market cycle where the market is most dangerous. I don't feel like I'm going to miss the upside in the cannabis stocks right here. And I think I might have a shot at buying them cheaper, particularly based on the fact that we just had that really good piece of news hit. Okay? I've been looking for another big investor in the space. And there's the announcement. Altria buys into the Kronos story. So the good news is out. Where's the reward from here versus the risk of a stock market implosion? And so this is the time where discipline is incredibly important, and it's very difficult. Because I love the space. I want to be a buy and holder. But when risk is too high, and in the short term, I don't see a lot of reward from here, I step aside. Even though it's my favorite group and it's the top of my whiteboard, and I'm going to be at it again. And the next window we have of risk on, when all of our indexes say it's time to put risk on, and we've covered shorts, first thing I'll be doing is buying cannabis stocks. Or maybe the second thing, because the first thing I'll do is cover my short and buy the indexes. And then I'll layer on the cannabis stocks. But don't fall in love with an investment. That's your ego talking. That's not intelligent thinking. You have to manage risk. That's what we're doing. So let's go over to the idea of buying gold stocks. Gosh, guys, I've told you twice now in the last few months, it's time to buy GDX. We bought it using our algorithm. We booked a small profit. Went back to cash twice. This is time number 3. And I'm not doing it right now. I'm not long. I may regret that. May regret it. But in my experience, when you're in the thick of a bear market and you're breaking down below the 200-day and the 50-day, and they're both rolling over and selling off the 50 and 200 on the big indexes, and to throw in, why don't I just throw this in? I don't really care about death crosses because they happen too late. I already need to be short, so it doesn't really help me. And everybody knows about them, so I don't love that theory. But every index has had a death cross now. The S&P had a death cross last week. The Qs, the small cap. I mean, it's like every single index. And when the market craters, let's look back at 2008. I mean, that's not really a fair assessment because that's like a financial crisis. But in 2008, you didn't make money going long the precious metal mining stocks. I mean, everything got wrecked. Now, we did make money long the metal at the end of 08. The metal was performing well. And those mining stocks really ripped higher at some point. But in the thick of the sell-off, man, everything becomes a liquidity magnet. The fund managers who are investing maybe in the precious metal companies, and the rest of his portfolio is melting down, he starts selling everything. particularly anything that's got a profit in it. So I'm just not that compelled to buy the group. And maybe I'm wrong. I mean, you know, I'll look to maybe buy them on weakness if they come back in and set up an opportunity for me. But it's the exact reciprocal of the market too, by the way. At least that's the way it's been for the last X amount of years. So until that's proven to be different, I'm going to go with statistics and probabilities. So I'm already short the market. If I go add a whole bunch of precious metals mining companies, and then the market reverses and rips higher for a couple of days, they're going to take down the gold stocks. That's what they've been doing. Now, if you want to bet that this is the time it's different, be my guest. And I guess what I'm saying on this podcast and this live stream is, I mean, statistically speaking, now's the time to give it a shot. I mean, the algorithm, I guess is what I'm saying, would say give it a shot here. I just can't get myself to get long. The algorithm that looks only at GDX says get long. It doesn't incorporate everything else that's going on in the world. Okay? So it says get long. If I'm in a cave and all I'm looking at is GDX, then I'm long. But when I look at GDX compared to all the other indexes that are imploding, I just don't see the reward here. Now, I know for all you precious metals fans, there's the long game that's playing out. And I could list for you all the reasons why precious metals prices should go through the roof, and they may. All of those things have been in place for the last 5 years, and it's been the worst place to have money. So to say, now it's happening, seems to just be banging on a drum that's been so wrong for the last 5 to 10 years that that's not good enough for me. I can't keep putting my money to work that way, right? So I have to use algorithms to tell me when to put money to work, and then I have to look around at the market and determine whether or not I want that risk on. And I guess for me, I don't want it on right now. You know, if I'm already short the market, I don't want GDX in the portfolio. Maybe for accounts that don't short, maybe for retirement accounts where you don't have margin, you can't short, maybe it's a good place to put some capital. In that case, because we have a risk on based on the algorithm, we look to buy weakness in the morning. So GDX was up over 2% on Friday, and it's up 1% right now. So that's not how I want to buy this thing. I need to have it come down. Now, this morning, it did come down to the VWAP of Friday. So that was your shot. You had a shot in the first 3 minutes of trading this morning, and then it ripped higher as the market imploded. So I guess I'm going to look for some weakness over the next couple of days. If I get it, comes back to the right price, and I'm in an account that doesn't short, there might be some room there to put some GDX on. So it's like a lukewarm buy signal, guys. All right, before we go in the last minute here or so, I do want to just give a shout out again to fundamental analysis. You hear me talk a lot about risk management and algorithms and shorter term investing trends. But we made a lot of money on Kronos last week because of fundamental analysis. And we've made a lot of money over the last couple months on a defense contracting company. I talk about it periodically. So it's just fun to remind you that you could still do fundamental analysis and make money even in a horrific market. Now, generally what I'll do is book those profits quick, like I just did in Kronos. Kronos. But I've yet to book it right now. We're long, as you know, shares of Kratos, KTOS. It's one of the top names on our whiteboard, KTOS. And if you look at my Twitter feed today, hashtag ARMR Report, I tweeted out the reasons why the whole defense space is going up. It looks like Trump wants to spend another $750 billion. Is that the number? It must be. An increase in the defense budget. And Kratos also got a whole bunch of upgrades across the board. So good job for us. It's up 7% on top of our other gains there. It's the only long position we have in the portfolio. Hope you all have a safe day of trading. I look forward to talking to you again tomorrow. And again, thank you for joining me. Take care.